Last week's market was, well, it was a real head-scratcher. On the surface, you'd think nothing happened. But if you peek just below that calm surface, it was an absolute battlefield, with some massive wins and some pretty brutal losses. So in this explainer, we're going to dig in and find out what was really going on.
First, let's just talk about the winners. Get this. One company, Tech Create Group, shot up by almost 1,000% in just 1 week. I mean, that is just an absolutely massive move.
But, it wasn't all good news. For every huge winner, there was a big loser. On the flip side, PennyMac Financial just plummeted over 30%. That wiped out a huge chunk of its value. So you have these two wild extremes, and they really define the week's hidden chaos.
So here's the central mystery we've got to solve. How in the world can individual stocks have such violent swings up and down when the market as a whole was basically flat? It doesn't quite add up, does it? Let's start piecing together the clues.
All right, so our first piece of evidence is looking at the specific companies that went on this insane ride. Let's meet the week's biggest movers. And what's really fascinating here isn't just what moved, but why. Tech Create's massive surge, that was driven mostly by speculation, just investors betting on its future potential, not its current results. But PennyMac's big drop, that was all about the fundamentals. Their earnings report really disappointed people. These two opposite forces are a huge piece of our puzzle.
So, we've seen the chaos in the individual stocks, but here's where it gets really weird. When we zoom out and look at the broader market scoreboard, the picture gets even more confusing.
Take the tech-heavy NASDAQ, normally the center of all the drama. Well, last week it was almost perfectly flat. After the great run it's had, this kind of suggests investors were starting to take profits, selling some of their winning stocks to lock in those gains instead of letting it all ride. And the S&P 500, which gives us a much broader picture of the market, it tells the exact same story. On the surface, it looks like a totally calm, uneventful week. But we know that's not true. So what was really bubbling just beneath this flat line?
And yep, you guessed it, the Dow Jones completes the picture, also ending the week pretty much unchanged. All three major indices, all looking stable. This just confirms our mystery, right? If the market itself was so quiet, where did all that crazy volatility come from? Well, the answer has to do with investor psychology.
The answer comes down to a concept called risk aversion. It's really just a fancy way of saying investors got nervous. And when investors get nervous, they stop making big, risky bets, and they start looking for safer places to park their money. But the real question is, why were they so nervous all of a sudden?
So what was making everybody so jittery? For that, we need to introduce the main character in our story, the U.S. Federal Reserve.
So, the Federal Reserve, or the Fed, as you'll hear it called, the easiest way to think about them is like a thermostat for the economy. If things are getting a little too slow, they can turn the heat up by lowering interest rates. If things are running too hot and inflation is a problem, they can raise rates to cool it all down. They basically control the temperature.
And last week, the Fed did something really important. After cutting rates 3 times in a row to get the economy going, they suddenly just hit the brakes. They held rates steady, and that sent a huge signal to investors that the era of easy money might be winding down.
And this is why that pause matters so much. Think about it like this. Lower interest rates are like a tailwind pushing stocks forward. It's cheaper for companies to borrow money and grow. But steady or higher rates, that's a headwind. It makes borrowing more expensive, and that can slow everything down. The Fed's signal basically suggested that the wind might be about to change direction.
Okay, so with the Fed putting everyone on high alert, investors immediately started hunting for other clues about how healthy the economy really is. Let's take a look at what they found.
So, the first and maybe the most important clue is all about us, the consumer. How were people feeling about their money? Were we still confident enough to go out and spend?
And the answer was a big, resounding yes. Consumer sentiment, which is just a measure of how optimistic we all are, didn't just beat what everyone was expecting, it blew past it. This was a really powerful, positive sign for the economy. But hey, one good clue isn't enough to calm down a nervous market. So the next big question was about jobs. Is the job market still strong, or are we starting to see some cracks? And on this front, the data was, well, a little more concerning. The number of people filing for unemployment benefits for the first time came in just a little bit higher than expected. Now, it wasn't a huge jump, but it was another small hint of weakness that just added to that overall feeling of uncertainty. Okay, so we have all our pieces on the table. A cautious Fed, some mixed signals from the economy, and a bunch of nervous investors. Now, let's put this whole puzzle together. The key that unlocks this whole mystery is a concept called sector rotation. And honestly, the sports analogy here is perfect. Think of a coach subbing players. When investors feel like one part of the market, say tech stocks, has had a great run and gotten a bit expensive, they sell those stocks and rotate that money into other areas they think have more room to grow, like energy or industrials.
So this is it. This is the whole story of the week broken down. Step 1. The Fed hits pause, which signals caution. Step 2. The mixed economic clues create a ton of uncertainty. Step 3. Because of that uncertainty, investors start to rotate their money out of those high-flying tech stocks. And what's the end result? A market that looks totally flat on the surface but is hiding all of this volatility as money moves around underneath.
And this quote just perfectly captures the mood on Wall Street right now. Bullish on earnings, but wary of policy shifts. What does that mean? It's simple. It means investors still believe that companies can make money, but they're getting really nervous about what the Fed and other policymakers are going to do next. It's creating this real split personality in the market.
So this leaves us with the big question for the weeks ahead, right? If the big tech stocks are taking a breather, where is the next huge opportunity hiding? Which sector is going to produce the next 900% winner? If you want to find out, make sure you subscribe and we'll help you figure it out.